All right, so welcome to the Everyday Investor, Paul Brownsey. How are you?
I'm very well, thanks. How are you?
Very good, very good. So let's just start off with who is Paul Brownsey? What is a chief investment officer as well?
It's a bit of a jack of all trades jobs in some sense, but fundamentally, if I think about what my primary role and my primary responsibility is to look after the interests of our clients from an investment perspective. So I have to make sure that the financial products that we're offering to our clients to invest in meet their needs, and the way we manage that money is always done with the client's best interest in mind. Beyond that, yes, there's a whole, like any industry, there's a whole bunch of sort of technical criteria you need. You need to understand how markets work. You need to understand the legislation around financial products. You need to understand, human psychology. You need to do a bit of marketing. You need to do some compliance work. You need to do some accounting work. You need to do, a whole bunch of ancillary things that sort of sit at the base of a big triangle, but just lead up to giving your clients the experience that they have signed up for, really, when they invest with you.
So let's maybe start off like at the very bottom, and we'll just build up some building blocks so that we can help people that might be even new to investing just understand, well, hey, what is it, even a financial product, right?
Sure.
So Pathfinder, that's where you're working. KiwiSaver, managed funds.
Yep.
Tell me, what is a managed fund to start with?
Okay, so a managed fund is really just I'll use the word vehicle, which I know sounds jargony, but it's a legal structure to hold assets, right? So it's like a trust essentially. So a lot of people have family trusts, and in that family trust they might have some shares and a property and maybe some business interests. It's exactly the same for a managed fund. It's the same structure, a trust like that, and that trust can hold any assets that the trust deed and the trust documentation allow you to own. Our managed funds, as I say, they're trusts. We have public trustee, which acts as the custodian of those assets. And they also have a job of looking after the client's interest as well. So they are essentially like a overwatch on what we do. Is Pathfinder managing the assets in that trust according to the rules they've set for managing those assets? So that's a big check and balance on any fund manager in New Zealand. So let's talk about one in particular. Let's talk about the Global Responsibility Fund, which is our product which invests in companies around the world. So in that trust, we have companies like Microsoft and Vestas, which is a wind turbine manufacturer, and a whole bunch of companies, probably around 150 companies at the moment in that trust. That's a managed fund. My job as the CIO who's responsible for that fund is to make sure we're choosing good investments to put into that trust, and keeping within the rules and doing what we like around ethical investing with those assets. But fundamentally, it's just a trust full of assets, and when an investor comes into that trust, they take a share of that trust in proportion to what they're investing.
I guess if people understand how a family trust works, there's settlers, trustees, and then beneficiaries of that trust. And the beneficiaries of this trust in this example is
the people that invest. That's right.
Right.
Yep.
So you need to act in the best interest of the beneficiaries, just like in a family trust.
It's very similar thinking. Yeah.
Yeah. Okay. And so with each managed fund, you would have a certain investment objective. Is that what you would call it? Like,
exactly
like
right.
Almost a charter or a mission statement?
Yeah. So at Pathfinder, we have two policies which govern what we do with our funds, two primary policies. In fact, if we did a count up, there's probably, I don't know, 15 or 20, some crazy number. Yeah. But the two primary ones, and we treat them as equally important. The first one's called a SIPO, which is a Statement of Investment Policies and Objectives, I think that's what it stands for. And so that sets the rules. It says you can invest in international companies. You must have at least 80% of the fund in international companies. You must have at least 5% in cash. Little rules like that. And so that's essentially the bare bones of what you can and cannot do with the trust's money.
Okay.
So think of it as just a tighter set of rules around the trust so that we cannot go off reservation.
So these set of rules would say, and if we accidentally use the word portfolio or fund, it's probably the same thing in the context of this discussion, isn't it? So that would say that the trust could have a certain amount in cash at any point in time, but they would set limitations in terms of how much would be allocated towards, say, fixed interest,
Correct.
which we'll come to in a
Correct.
second, and then equities and all that sort of stuff.
And also, for instance, the CIPO for a equity fund might say you cannot invest in illiquid assets like a house or a building. So those things are off reservation, and we have to stay within the reservation, essentially.
Okay.
So that's the first document.
Yeah.
The second document is our ethical investment policy.
Yes.
At Pathfinder, we have a pretty strong belief set around investing, the right way, and we define the right way as, we want to invest in a manner which sort of preserves the value, both financial and sort of non-financial value around what those companies do. So, we're trying to minimize harm to the planet. We're trying to minimize harm to society. We're trying to minimize harm to people. And so that's governed by our ethical policy, which sets a lot of constraints around things we won't invest in, but also equally important things we do invest in. A lot of people now are screening and saying, look, we don't invest in tobacco companies or weapons companies and so on. And that's great. That's a perfect way to start. But probably more importantly is to say, well, that's great, but can you actually have an impact with your money as well? Can you get a good return for your clients, but also invest in areas which has got a positive environmental or social impact as well?
So one set of screening would be almost a restrictive, defensive.
So get away
stance.
From that. We don't like that. Yep.
And the other one's more like an aggressive. We want to include that because we want. And effectively, it's just choosing the flow of where the investors' funds are going to create change, positive change in the world, but also presumably, hopefully,
make money
returns.
Which
is, I think, when we boil it all down, that's kind of what we really want. And if we can do that without killing everybody in the process, hey, that's a bonus, isn't it?
Yeah, sure. So going back to our conversation about what's a CIO, so everyone talks about wearing a hat at work of what they do. I wear two hats, right? So on the one hand, I'm saying I need to make as much money as I possibly can for the investors. I never lose sight of the fact that I'm an investor. Right, I care about making some return. I've got friends and family in there, and I want to show them a good return. And anyone in our KiwiSaver is literally saving this money for their retirement. So I want them to get to age 65 and go, oh my goodness, I've got a big chunk of change here which I can fund my retirement with. That's a really positive thing. But I want to do it in the right way. Right, I don't want to do it in a way that's imposing other costs on society or the environment.
Right, and that kind of drills down though into the ESG, environmental, social governance principles that I've been covering a little bit in the last few months, not necessarily from a pro or con point of view, but just from a reality that is just another set of rules that you can choose to adopt or not in how you personally invest or how you choose your fund manager, or in this case, which provider you want to deal with. Because if you know that it's happening, then for some people, I guess that gives them a little bit of comfort knowing that they're not doing evil, right?
Yeah, like if I say to somebody, look, I can give you, and I never say this because I can't say I can give you a return, but let's say you can invest in a tobacco company and get a 10% return, or you can invest in a renewable energy company and get a 10% return. Most people are going to say, well, I'll take the renewable energy option because I can feel good about myself. I mean, I don't want to invest in a tobacco company because it's a business whose business model is predicated on killing its consumers, right? Used as directed, tobacco will kill you. I don't want to be investing in a tobacco company. You talked about ESG and ESG data. A lot of the ESG data is harvested from company reports and annual reports and various other forms of data. And it really tells you about, does the company have certain policies in place? And does the company measure itself against those policies, and does it report on those policies? So some data sets have got a couple of hundred data points now, things like, does the company have a policy around waste management? Does it recycle? Yes. What's the metrics around the recycling? So you get data like that. And you get it right across the company, across customer-facing things, social factors, staff factors, environmental factors. But none of those things actually says, what is the purpose of the company? And is this a good company? And the clearest and starkest demonstration of this is that in one of our ESG data sets, if we rank every company, and there's thousands in this data set from number 1 to the worst, I think the number 5 company at the moment is a multinational tobacco company.
Wow.
Right? So if you build a portfolio saying, I'm going to choose the top 100 ESG companies in the world,
The fifth
you'd
one is a
have the
tobacco
fifth one's
company.
tobacco, and I think the 19th is tobacco, and there's obviously a lot of fossil fuel companies in there as well. So
Because they've effectively not goosed the system, but
well,
they understand the rules,
they
don't they?
understand the rules. Let's just say that, right?
Yeah,
So in itself, ESG data doesn't actually tell you whether a company has got a good purpose or doing a good thing.
sure. It doesn't tell you the quality of the wood, just the quality of the fruit.
Correct.
And you can fake the
That's right.
fruit
Yeah,
for a
that's
short
right.
period of
Yeah,
time.
yeah, yeah.
Okay. Interesting. So how can you then offset that? How can you then
Okay,
kind of go deeper?
So the way I personally think about ESG data, and there's quite a lot of research in the industry about this, and we've done a certain amount of research ourselves, which tends to validate this view. The way I think of ESG data is that it gives us another tool for measuring company risk.
Okay.
Right. So traditionally in financial markets, when you're running a fund, you do things like, oh, let's look at the cash flow of the company and their business model and their valuation and what their earnings are going to be like over the next 3 years potentially. And those sorts of metrics are very well understood.
Yeah.
And that's the typical way we look at companies. Now we add this ESG filter on top of that by saying, okay, we think there's a lot of business risk around ESG factors related to carbon intensity, for instance. So a company that's emitting massive amounts of greenhouse gases has probably got a lot of risk in their business because of they're probably relying on coal or oil for starters. They've got some potential stranded asset risk down the track. They've got regulatory risk. They may have extra costs in terms of offsetting and so on, which they haven't recognised yet. So ESG data can give us another way of looking at potential risk in a company, potential financial risk in a company.
But it's a bit more on the qualitative side of that spectrum, isn't it?
Very much so, yeah.
So it kind of puts into context. So initially you might be looking at return on investment and the debt levels and all that sort of thing, all the normal traditional things. Yeah. But then the next layer is the ESG filter that you put on top of it, which is more of a qualitative analysis.
That's right. And a lot of those ESG factors are quite forward-looking. So carbon intensity is a really good one. If you're in a industry which has a carbon intensity of 25 tons per $1 million of revenue, and and your own intensity is 125, well, maybe there's something about the way you're doing business in the industry which is different to everyone else. And is that a good thing or a bad thing? So it allows us to drill into companies that way as well.
I see. And just to kind of put that into a little bit more context, it almost doesn't really matter, because I often, when I'm talking to clients, I'm often getting feedback which contains a healthy dose, and I think it's still a healthy dose of cynicism around anything in this space, because it just means that they're thinking critically. Which if you follow that through, if there's truth in this, it means that they become a believer at the other end.
Yeah.
And so when I see this, I kind of go, well, why is that relevant with respect to the carbon thing? Well, if there's going to be a whole bunch more investment flowing into this sector, which moves in this pattern, then really there's a tailwind, isn't there?
Absolutely.
We were lowering the cost of capital for certain things, for certain reasons.
That's right.
There'll be better returns in the long run, in theory, as a result.
That's right. The other anecdote I like using is, because of our exclusions, and our exclusions probably go further than most managers, and particularly around fossil fuels. So we try and not invest in any company whose primary business is the extraction or selling of fossil fuels, and particularly around coal as well. So that, in terms of the opportunity set we can invest in, that's a whole sort of 4 or 5% of the global market that we can't even look at because they're fossil fuel companies. So we don't even look at that in our mix. So it's not an option for us to invest in.
Okay.
So as CIO, my team and I spend pretty much zero time looking at ExxonMobil, for instance, because we can't invest in it. So it's not even on our menu, right? But as an alternative, we've spent a lot of time looking at the renewable energy industry, right? And over the last 20 years, the rate of growth in renewable energy has been, it's varied between sort of 5% and 30% per annum, and probably running at 15-20% per annum at the moment.
Wow.
Okay. The fossil fuel industry, demand for fossil fuels typically grows at between 2 and 5% per annum.
Right.
So I like to say, look, I'd rather be a average investor in renewables at 15% per annum than a genius investor in fossil fuels at 3% per annum.
Right.
Because your outcome's probably going to be better.
So
for me, the fact that we can't invest in those fossil fuel companies is not so much a cost. I think it actually is an opportunity, because it's forced us to say, let's really get to grips and understand renewables better, and where the company makes financial sense, let's go hard on that.
this is a little bit more of a tangential
Mm-hmm.
question around this, but you're probably a good person to ask this question. Whenever I see the two-sided coin of risk and return,
Yep.
I always kind of think, rightly or wrongly, that they're obviously very, very connected, right?
Mm-hmm.
Risk and return. The more risk you
You
take, the
dial one
more.
up, the other goes up. Yep.
Yeah.
Yep.
So, and I'm thinking about this in reverse though. So when you see good return, like what you're saying about
Mm.
renewables and the average rate of return, say 15% in renewables for
Mm.
a certain period of time so far, does that give us a clue that there is risk, but we haven't seen it yet?
Quite possibly, and it's not always plain sailing. Like right now, renewable energy companies, particularly those in the US, are having a really tough time. And that's driven by factors we think we understand pretty much around higher interest rates and some of the political uncertainty in the US as well is driving that. But we look at those businesses on a granular basis and say, we still have a very strong financial thesis around why we invest in those companies. So is there more risk in those companies? We don't think so, right? But the amazing thing about risk, or maybe the brutal thing about risk, is that you can only really measure it properly after it's happened.
Yeah, that's right.
You can estimate it in the future.
Yes.
But it's after it happens that you find out whether you actually understood the risk or not.
And I think emerging markets would have been an example,
Exactly.
right, in the past.
Yeah.
Okay. So just going back down to the basics now again. So thinking about your role as a chief investment officer, at some stage there has to be some sort of design in what this fund is actually going to invest in. And so how do you determine the optimal mix of the asset classes? So maybe if we could define generally speaking, what the asset classes are.
Sure.
That would make up a fund. And then how do you determine the mix?
Really good question. And I can give you, how many answers would you like?
At least 3 or 4.
Okay.
Yeah.
So look, fundamentally, the first way we think about risk is to split it into growth and income.
Okay.
And so growth tends to be more risky in the sense that you can't actually measure it ahead of time as well. So we're talking about investing in a company directly here. And so if we use Microsoft as an example, that's a great growth company. It's given us massive growth over the years. So I think anyone that invested in Microsoft when it started, with just a few $100s would be probably a millionaire by now, I'd guess. It's been phenomenal. So that's a growth company, or a company in the growth sector. If we invest in Microsoft today, we don't know what the return from Microsoft's going to be over the next year or 5 years. We can guess about it, and we can say, well, it's got earnings of this much, which will come back to us. We think we'll get X% from Microsoft over the next 5 years. So that's a typical growth asset. A typical income asset has a little bit more certainty around it. And here you're more taking what we call interest rate risk and credit risk with income securities. So interest rate risk is the risk of yields changing. So at the moment, if we invest in, let's say, a term deposit for 1 year, you might get 6% in New Zealand at the moment. 2 or 3 years ago, you were getting 2 or 3% for that same. So it's obviously a much better time to be investing in that now. And with a income asset, there's pretty good certainty around what you're going to be getting, because in the TD or the term deposit scenario, the bank says we will pay you 6%. Right, so your 6% is not at risk unless the bank fails.
Yes.
Right, so that's the credit risk part of it. But if you stay in what we call the investment grade world, which is companies that are rated as being secure, the risk of losing your money through credit risk is relatively low. You marry up the two things. So you can say, if we build a portfolio with some growth assets in it, that'll give us a long-term gain, which should beat inflation. And if we have some income assets, that'll give us some stability of that return as well. So it's not going to be up and down as much. And so you dial those two things up and down. So if you're a conservative investor, you're typically going to have a lot more in the income bucket, maybe 80%. And 20% of the growth bucket. But if you're a growth investor, you're 25 years old, you don't need your money until you retire. Often, that's where people dial up the risk, and they end up with perhaps 80% in the growth assets and 20% of the income assets.
So you invert it. So the conservative and the growth are pretty much inverted in terms of 20-80, 80-20, generally speaking. And then you get ones that are way more intensely growth orientated, or just all like super safe.
And look, that's the skill of the financial planner, right, is to understand the client's needs and say, your personal financial situation is this, your requirements are this, your behavioral biases suggest this, your time horizon is this. I think you should be in a growth or a conservative portfolio.
The advice that you receive will be fine-tuning it to the specific requirements
Yeah.
of the actual investor.
Yeah.
But at the fund manager level, you're constructing it, aren't you? You're constructing the frame of it, the container of it, so that I guess the advisors or consumers directly can then make an intelligent, informed decision around
Correct.
what they're going to get, right?
Correct. They will know that if we're saying this is a growth fund, it should behave in certain ways.
Sure.
Now, as a CIO, I can't actually predict markets. I mean, surprise, right?
Yeah.
But I can't pick turning points. But what I can do, and this is the art of any fund manager, is what I regard as success is building, robust portfolios that behave as expected in certain market conditions, right? So if the market's up 10%, you should look at a portfolio and go, I'm up X%, which makes sense in a 10% market move. Right?
I see.
Now,
Okay.
if the market's up 10%, you're in a growth portfolio and you're down 10% in your fund, something's really, really gone wrong, right?
Yes.
And you should be asking questions of your fund manager.
Okay.
Right?
So
because he's not built a portfolio which is built to do or to be consistent with what markets do.
Sure. Okay. And so there's two elements here, I guess, with a portfolio in terms of how it's designed, right? Like there's two things that you're trying to optimize for. You're trying to optimize the return, and then you're trying to optimize you're trying to get lower volatility or the ups and downs. You're trying to minimize that, aren't you?
Yeah, the volatility one is interesting because, what volatility is, it's just purely a statistics metric, which is the standard deviation of your return, right? So does it give you a lot of information? I'd argue it really doesn't. We can say our portfolio has a volatility of 9%. What does that mean? Well, it just means that there's a certain number of times you expect your returns to be within plus or minus 9% of the benchmark. But that's not really meaningful for most people.
Right.
So we absolutely use that sort of that dimension of risk when we're building portfolios because the mathematical process that we use demands it. But as an investor, I think what you really care about fundamentally is, will I get my money back? Right? That's the first thing.
That's the risk
That's
part.
the first part of the risk you care about.
Yeah.
The second thing is, will I get the return I'm expecting? When we build portfolios, we try and think like that as well with clients. And if you run through the logic of what we're doing, it ends up with us spending a lot of time thinking about downside risk. And so downside risk is what really kills returns. If a market goes down, that's downside, right?
Sure.
So, the S&P 500 is at a price of 4,000 right now. If it goes down to 3,000, you've lost 25% of your money, right? We try and build portfolios which minimize that downside risk as much as possible. And there's tools we have to do that, which can help us. And again, the anecdote, I'm full of anecdotes, right?
That's good. Bring it on.
The anecdote I like using is that if the market goes down, or if you're invested in a market and the market goes down by 50%, you've lost half your money, right? And the return has been minus 50%. To get back to where you were, you've got to double your money. That's a return of 100%.
Yeah.
So it's really unforgiving, the math.
That's right. And that's why you have to be so precious about limiting your downside risk, right?
Yeah. And the brutal math too is that if you're a manager which is just average on the upside, but you avoid the downside, you'll be a superstar over 10 years or 20 years.
Gotcha. Yeah, that's right. It's hard to think like that because you normally just would look at the average positive rate of return and make an assessment on that. But you're really missing a massive amount of the story if you don't look at that downside drawdown rate, right?
Yeah. Okay. And so as an example for us, when COVID hit, it was crazy markets, and I remember being up all night and watching markets and doing stuff. It was just crazy times.
Yeah, it was a weird time. I think from
crazy.
like August 2019 onwards, I recall like there was some weird stuff going on, which I think maybe passive managers, and we'll talk about active and passive in a second, but passive managers would have just been
they stay in. Goes. Yeah.
But I remember hearing a few people going, well, we actually have a high allocation towards cash right now.
Yeah.
I guess you guys
we're in that category. And look, it's not, for me, it's not rocket science. My team and I were looking at all the stuff, and to be perfectly frank, we didn't really understand what was going on. So we were cautious because of that.
Yeah. Bringing it back down to the basics. We've spoken on this show quite a few times around active and passive management.
Yeah.
I try to keep relatively neutral on this because I think in this, to a certain extent, the jury's still out, or there's pros and cons in my view anyway. But can you for the benefit of our audience, explain from your perspective the difference between active and passive in terms of a management style or investment style.
You use the expression the jury's still out. I don't think it is. I think the jury's in, and the jury is saying that both are valid, right? There's no one right answer because different people, different portfolios have different needs, and sometimes some passive tools work and sometimes some active tools work. I'd hate to sit here and say you've got to be one or the other, and I think smart managers probably see the value in both. Yeah, they both have pros and cons. So if you can use this side for the pros and this side for the pros, hopefully you can build a better portfolio for your clients. Passive implies that you're not making decisions about where you invest the money. Now, that's not completely true because every passive manager has made the active decision to go passive.
That's right.
Right? So there is some active decision making in there.
And you can go the other way as well, where you can be passive but use active tools.
Correct. Yeah. Exactly right. So if we think about from a New Zealand context, we've got the NZX50 stock market here, right, which is the top 50 companies in New Zealand, and they're all on that index. And the index is calculated by saying, okay, if company A has 5% of the value of that index, it's going to be 5%. 5% of the market, it's going to be 5% of the index. So every day, in fact, every second, they calculate the value of that index. And you can know with some degree of certainty that if you owned the top 50 companies in New Zealand and the same weights as the index, you would have the same return. So we see on the headlines at night that the NZX was up 5% today. Your portfolio about 5% as well. But you're not making any decisions apart from the fact that you've bought the index.
Correct.
So that's passive.
Yeah.
So if it goes up, it goes down. You don't change your view. You get new money, you put it in, and you keep on tracking that index as close as you can. From a passive perspective, it's got the advantage of saying we're in the market. We don't have to hire all these expensive managers and CIOs and data services and ESG stuff. We can just chuck our money in and go and do marketing. Right?
Yes.
So active is different. Yeah, we're saying that. Well, we don't believe that markets are perfect. We believe that in markets there are inconsistencies around how companies are valued, how markets work, how capital flows go, how people react to macroeconomic news around inflation and interest rates and things. There are some parts of markets which do have quite strong predictive value about where returns will be over the next certain period. So we can all use those tools to make what we call active decisions. And so while we're still fishing in that same universe of the 50 largest stocks in New Zealand, we're saying, we don't like this company, we don't like this company, we're going to invest in this company. And so in our New Zealand portfolio, we've probably got about, I think around 15 stocks. So we don't have 50, we have 15.
Right.
So we've got some very active decision-making risk in the fact that we own some companies in greater weights than the index and some companies in lesser weights or even zero versus the index. So we will have what they call tracking error, and that is the difference between the index and what our portfolio does. So the amount of tracking error you have is what one of the essential definitions of what is an active manager. If your tracking error is zero,
then you're just a closet indexer.
You're an indexer.
Yeah.
If your tracking error is, call it 5%, so your returns could be plus or minus 5% of the index, that's a pretty active manager.
I see. That's a good number to reference, I guess, if you're choosing funds or choosing providers and you're paying maybe a higher fee for the privilege of having active. If they're not actually really doing anything active,
that's right.
What are you really paying for? Right?
Yeah, so that's exactly right. So there is a tyranny around investment management as well, which is that what are my competitors doing? What is the index doing? I don't want to underperform. And so another part of my role as CIO is to try and move us away from that and say, we don't care about what our competitors are doing. We don't really care about what our index is doing. What we care about is, are we delivering what our clients want and what they signed up for, right? It's hard because, nobody likes underperformance. And, I've underperformed from time to time. I've outperformed from time to time. But I tell you, I'd much rather have outperformance than underperformance, right?
Yeah. And I think this is one of those weird sort of paradigms, I guess, where you are measuring yourself in a way, according to the index, right? But you don't want to make that the focus, do you?
No, because then you become passive, right?
Exactly.
And I think I spoke earlier about downside risk. I think downside risk, if there's one thing that you can do as an active manager, it's do a better job on managing downside risk, because ultimately that's I strongly feel that's one of the biggest financial contributions you can make to your investors is by minimizing downside risk.
That's interesting.
Yeah.
Because I've heard criticism of that approach, that if your number one objective is, hey, we don't lose investors' money, then you're actually taking your eye off the ball of
On the upside.
of the upside.
Absolutely. Everything's got a trade-off, right?
It does,
Yeah,
and everything's held in tension.
Yeah.
And that's why, again, the difference between active and passive, like you say, the answer is no, they're both right.
They're both right in certain circumstances. Yeah. And the other way we think about markets is that we're looking for particular characteristics in the stocks we buy. So we look for companies with higher than average quality.
Right.
We look for companies with consistent earnings growth as opposed to up one year and down the next year. So we like stability in our earnings because that's going to help with our downside risk. Okay. Right. If a company's got stable earnings and the market falls, the market can still fall, but it's probably going to fall by less than the overall market because it's got much more stable earnings.
Yeah.
And so it's creating a good mix of companies that have the sort of attributes that we like.
Sure. I guess you could almost think of this in terms of a household where, say, there's two incomes. One income is a school teacher on a nice salary, pretty boring.
Never get fired.
Never get fired, not normally. And then the other one is maybe a real estate agent with really wild income, right?
Sure.
Like over the long term, you want to have that downside protection with this stable income, but the scope for possible gains, right?
That's the best example I've heard of the growth income. Right, split, right?
Yeah. Yeah, that's right.
Yeah. You're a good teacher. You're always going to be in demand, right?
So if you're investing in businesses that is producing something that's always going to be in demand, producing maybe good dividends and just solid, not that rock star performance, but it's just slow and steady.
Yeah. So typically companies in that category are things like they call them consumer staples companies. So something that you always buy, demand doesn't go up or down that much because people need to eat, right?
That's right.
Yeah. So but things like electric vehicle, that's probably consumer discretionary because when the markets are good, everyone that's had a boost in income is going to go and buy an electric vehicle potentially. Right. But when the economy is poor,
correct,
that slows down.
Okay. Yeah. And so on that then, like when we're thinking about having an active style of investing as a fund manager, when risks and opportunities appear, and there's cyclical and then there's secular trends. How does it work in terms of the human intuition aspect of this? Because there's science and then there's something doesn't feel right about this.
You can't lose sight of the fact that the science is trying to essentially read the behavior of humans. We think a lot about history. What happened in the past? We had an environment like this in 2000, whatever. Is it similar now? What's different? What does that imply? Right now, though, we're in kind of crazy times with inflation, particularly.
Totally, yeah.
And I think we've probably had the largest increase in interest rates in the shortest period of time ever in the last few years, and yet our economy is still humming along. We think about what's happening out in the economy, in New Zealand and overseas, and just try and form a view on what does that mean? If interest rates stay at 6 or 7% for 3 years as opposed to 6 months, what does that mean? Well, it probably means you don't want to be, owning companies that rely on borrowing lots of money, right?
That's right.
So we'll try and steer clear of those.
Let's just say, for example, let's say there's a view that maybe the market and all participants in the market believe that in 12 to 18 months, interest rates globally will start to come down. But let's just say the market's wrong. Going back to what you were saying before, I guess you were touching on the efficient market hypothesis. Let's say that there are pockets of unknown bits of information, contrarian views that end up being right. And let's say interest rates have to go higher for a lot of reasons, which we don't need to go into. What happens then to, say, the income portion of your, say, 60-40 portfolio?
Well, it's going to be hurt because if you think about the income part of the portfolio, let's say we invested that now at 6%.
Yeah.
Great, we're getting 6% of the money. But as you say, if rates go higher, all of a sudden we can now get 8% for our money. But I've locked in at 6. So therefore, the way markets work is the value of my 6% money is going to fall until a new investor in that money would also get 8%. Kind of counterintuitive, but when interest rates go up, the value of an interest rate product goes down.
Yeah, they're inversely related. Yeah. And so again, going back to the growth assets in that portfolio, interest rates go up.
A lot of companies that rely on borrowing capital, they'll possibly go down as well.
Yeah.
But equally, there are some companies that aren't as exposed to interest rates. And as long as they're still selling their products and making earnings and what have you, and the outlook's good for them, they can still do pretty well in that environment.
Right, because I guess their sales might be, well, hey, if there's higher interest rates, chances are there's higher rates of inflation, which then gives you
boost
a higher
sales and what have you. Yeah, exactly right.
And that sometimes offsets it. So it's kind of a strange thing to think that even with income and growth assets, you can still get the ups and downs happening in equal manners. They're not perfectly negatively correlated.
Historically, it's relatively unusual because, and not always true, but generally there's been a reasonable correlation between when growth markets go up, interest markets are stable or go down, and when interest markets go up, growth typically goes down. So that's typically, and that's sort of this diversification effect you get by saying, I'm not putting all my eggs in one basket. So if something's winning and something's losing, that's better than just being in the loser, right?
Correct.
So, but last year was kind of insane because we had these massive interest rate hikes, plus we had company returns starting to fall as well. But it was really unusual for an income portfolio to behave as badly as it did last year. But as I said, it was historic in terms of how much rates went up by. So that's why. But there's some pretty surprised people around who had invested in income funds, with the expectation of getting like a boring 3 to 4% return. And last year, some of those funds were down 10 to 15%. I think you'd have a pretty difficult job explaining to investors, why we put you into a fund which we thought should do 3 to 4%. It's actually down 15%. That's a pretty big miss.
It is, isn't it?
Yeah.
And how much of that is down to the fact that, hey, the world might not be going through just a cyclical change, but a secular, like a much
long-term
longer trend change?
Yeah.
Like, do you think that the world, well, we know that the world has been quite weird over the last few years, but is this maybe the beginning of a new, let's call it a regime change?
Yeah. Most dangerous words in finance are it's different now, right?
Yeah, that's right.
I don't know is the short answer on that. Look, I know in the US, we're back to interest rates which were last seen 16 years ago. But I'm sure if you lived through the 1990s and the early 1990s as an investor in fixed income, what's happened now wouldn't be too surprising potentially, right? Because it was pretty tough for yields back then as well. So that's a long time ago. And most people in markets, myself included, were investing that period. So it was maybe not front of mind. But I'm not sure what we're seeing is so
unusual.
So unusual that we should be going, oh my God, this is a different world. Something's changed dramatically. I mean, things are different, don't get me wrong. But if I sat here and said it's inconceivable that we could have a minus 15% loss in a bond fund, you just can't say that because it has happened. It happened last year, obviously, but it's also happened in the 90s, I think. So, and certainly in the 70s as well was another time it happened. What's been different over the last 10 or 15 years was the fallout from the GFC. And as a result of that, we had just vast amounts of money injected into economies from central banks. And I think that's left us kind of with the inflation problem we have now, that eventually that's caught up with economies and it's created too much liquidity in economies for
that excess liquidity somehow needs to be
drained out somewhere
or absorbed somehow, right?
And the trick is, how do you drain it out without hurting the people in the economy who are most at risk, which I don't see billionaires complaining about higher interest rates, but I do see people working 2 jobs complaining about higher interest rates, right?
Yeah, that's right. It seems like that's the way things work, unfortunately. If you look at the change that is happening, though, with either a historical or a future-facing lens, do you feel like the investable universe is growing or shrinking in terms of like, well, hey, maybe we have a different type of performance in the new world, therefore we need to be accessing new tools and new ways? Or do you kind of think, no, we don't really need to change too much?
No, look, I think you've always got to look for change, because if you don't look for change and change happens around you, it can be pretty painful.
Sure.
If you're not managing that change. I don't think there's any really new products out there, right? The GFC, went through a period there where there were all these new products and people were going, man, we can invest this stuff and it's risk-free and it's great. Of course, it wasn't risk-free and it blew up.
Yeah.
And with hindsight, you looked at those sorts of products, and what they were was just the same products as we had before, which was mortgages and bonds and stuff, but they'd put leverage into them, right? So that
it's
leverage,
more sophisticated, more complicated.
Yeah, just more tricky fee-paying ways for investment banks to create income. So I don't really see unusually new products out there that we can invest in, but I think there's in products that have always existed, there's more going on, if you like. So one of the things we're really keen on, and somewhere we think we can make a good social or environmental impact with our money, is in the world of private equity.
Yeah.
Okay, so private equity is interesting. That's just investing in a company, but it's in a non-listed company. Yeah. And typically it's a company which has started recently and is growing. So we've invested in a few companies at Pathfinder, which I can go through in a second. But the idea there is that you're investing in an unlisted company which has its drawbacks, because we can't turn around and sell it now. So we have to be very careful about the liquidity aspect of it.
Sure. Yeah. So your ability to turn it back into cash is limited.
It's limited.
So we have to make sure that
it's really limited. It's zilch in some sense. Right?
Sure.
So you've got to manage liquidity. We can't get our cash back in a hurry. So we've got to be very careful that it only becomes a small part of our fund.
Sure.
But the returns from private equity can be very significant. If a company gets their business plan right and grows properly, we don't talk about a 5 or 10% rate of return. We talk about 5 or 10 times our money back, which is pretty cool, right?
And so does that kind of then start to give you the idea that maybe you could actually craft portfolios that are even way more stable, let's say, but you have this bolted on spicy element in private equity that gives you the outperformance in a different way?
Yeah, I think that's a good way to look at it. Yeah, you're sort of touching on the aspect of, or the idea of diversification. Yeah, you don't want all your investments in the same sort of thing.
Yeah.
Because you want different industries, different sectors, different business models. If you use other managers, you want different managers, you want different markets. The more you've still got to build a coherent portfolio which behaves when combined in the way you want it to. But you can sort of reduce some of your underperformance risk or your downside risk by saying, let's not put all our eggs in one basket.
Okay, interesting. Going back to almost the start of when we had our conversation here, we talked about the set of rules that the trust might adopt or the fund might adopt, and then we talked about the the environmental, social, and governance principles, the ESG principles that you might choose to follow as another guiding light or guiding factor. Around the ESG piece in particular, what's unique about Pathfinder, from what I understand, is that they're one of the few providers out there that I know of that have this ESG kind of at the core part of who you are, but you're also an active manager.
Correct.
And I wonder, in sometimes where there needs to be an active decision, like speed type thing, does that impede you in some way? Are you somehow hampered when you make these decisions?
Sometimes you can, because you've got to do your research, right? Yeah. And for a start, active management is always going to be more expensive than passive management, because you need more people to do it. And then, I would actually broaden out the ESG description to call it a part of what we do in our ethical policy. Sure. Right. So I'd say being an ethical manager,
I see,
that's
the core.
Yeah. So we use ESG as a tool in our ethical process.
Okay.
But being an ethical manager is actually another level of compliance and analyst time and thinking on top of it. So it gets really hard. And sometimes you can't move as quickly as you'd like to, because we don't want to do the wrong thing, right? Even unwittingly. If you can run that process well, I think it will give us superior outcomes for our investors in the long run, which is what I care about mostly.
Got it. Yeah. Okay. So, but I guess what I'm hearing is that, it can slow you down. But in a sense, some of that could be pre-cooked, pre-baked, right? Like you kind of know the pathways that you would follow if certain events happen.
And look, we have a lot of models, sort of technology we can help with as well. We have a lot of databases we can search quickly, and we use different providers to give us information. So, it's as I say, it's not unheard of, but it's pretty rare that we make a mistake on something. And if we make a mistake, our approach is to say, "Hey, we made a mistake."
Yeah.
And
on that,
and we fess up. And
I'm curious. Like, let's say, for example, for whatever reason, there was either an opportunity or a risk that caused you to make a decision, and it was great from a return point of view, but it was later found out that it was terrible from an ethical point of view.
Yeah.
How do you handle that?
We learn from it, essentially, right? Okay. So we just try and think about not putting ourselves in that position again.
Okay, so it's not like you...
Yeah, we're not like a Islamic finance fund where you can sort of fix that by donating the money to a charity. I mean, that's not our approach. We do plenty of donations elsewhere in the company.
Yes.
Our main approach is that, we do some soul searching and think, why did we make that mistake?
Okay.
Was it something we sort of missed some obvious things on, or was there a hole in our process completely? And we respond to it accordingly.
Yeah. Okay.
So,
good. Which kind of makes sense. Like, I guess your investors, well, they're certainly not perfect.
No.
So why should you be holier than thou, right? It doesn't kind of make sense.
Exactly. And look, we get a lot of, I think perhaps because we do have this ethical approach to what we do, we a lot of our investors are probably more highly involved or engaged than for other managers. So we do have quite a lot of feedback from our clients. So sometimes it's slightly informed because it comes from a conspiracy theory background, which people are entitled to think what they want. But if something's not true, we won't follow it, right?
Yeah.
But I look at a lot of our investors as being almost like an unpaid army of analysts for us. And some people have actually worked in some of these companies overseas potentially and say, hey, I work for XYZ and you've got them in your company. Did you know that they do this?
I see.
Okay? And so we've got these unpaid analysts who help us from time to time, which is pretty cool.
And the level of information that they provide, obviously you put another filter on that, of course, but that's one of the things that you could consult. So
what it would do is if somebody said, look, you're invested in this company and I think they're bad because of this reason.
Yeah.
Right. So what that does is it essentially triggers a process where one of our team will say, okay, I need to go and investigate those allegations, essentially. It's like being a policeman in a sense, So we will then look at the information we have about that company and hope that it doesn't say that, right? And typically it doesn't, but then we'll sort of do a deeper dive. We may engage with the company directly.
Yes.
We speak to their, management or investor relations team to say, hey, what about this? Ultimately, it triggers a research process where we say, is that true? Yes or no? And if it is true, does it trigger a breach with our ethical policy?
Yeah, okay.
And we've got some pretty laid out procedures for dealing with that sort of situation.
Okay. Now, just thinking about Pathfinder in particular before we finish up. So 2009, correct?
Yep,
is that
correct.
when Pathfinder started? I think probably the biggest run on the board in the early days was the Water Fund.
Correct.
Is that right?
Yep.
Tell me a little bit about that.
The Water Fund was sort of our first fund which, I wouldn't say had an ethical bias at the time, but it certainly had a sustainability bias at the time. John and I had thought about this fund and it was triggered with some conversations with an advisor who said, look, you guys should look at water because water is probably the biggest issue we have in the globe at the moment, right? Which we said, oh, well, it sounds dramatic, but we went away and thought about it into this research. And, we thought about sort of global macro trends in the world around urbanization. There was this massive drift of people from, rural lifestyles to urban lifestyles in developing countries. And the urban lifestyle typically came with a greater burden on water infrastructure.
Right.
There were rising living standards going on. So people were, eating higher protein diets and so on, which, they were eating more meat, which is water intensive, and food was getting flown around the world, which was bad for climate change and stuff like that. A few other trends around, the climate change was making wet parts of the globe wetter and dry parts drier. And it just so happened that most of the population growth in the world was coming in the dry parts. So to us, it sort of created this multi-decade theme around the need for new infrastructure in countries.
Yes.
And the need for replacement infrastructure in places like Europe and the US, where some of the infrastructure is over 100 years old.
So this is effectively an infrastructure fund primarily,
partly
devoted to water.
So essentially the companies in the fund are broadly speaking in two camps. They're either utility style companies who are finding, treating, delivering water as fresh potable water and then taking away wastewater and treating it. So that's probably about a third of the portfolio.
Okay.
And 2/3 of the portfolio is probably around infrastructure. So it's people that make pipes, pumps, water meters, treatment systems, and sell that into companies that deliver water. So
more of a thematic.
Yeah. So it's very much designed around these 4 or 5 macro themes we saw happening, and they've played out really well. I mean, the fund's sort of delivered 9 or 10% per annum consistently over the last how long is that? 15 years almost, right? So it's been a good sort of growth fund for people.
Okay. Yeah. Tell me also then about green bonds. What can you tell me about that?
A bond is like a loan you make to a company, but a loan is typically done from a bank. A bond is essentially a loan type product, but it's done to the market, so different investors can sign up and participate in that green bond. And so companies are borrowing money through the bond market all the time. Happens, a couple of times a week, potentially in New Zealand, where a company comes in and borrows money. And what they do with that money is use it for general corporate purposes. So they can use it for anything that the company is allowed to do. The green bond is the same structure, but it's got one added twist. And the added twist is that bond, or that money they're borrowing, has to be used for a specific environmental purpose, right? So it's possible for a company that's not very green to issue a green bond. And that's kind of where do you sit on that spectrum? I'm kind of see it as both good and bad, and I'm not quite sure.
Still open-minded.
But ultimately, I think that, no matter who's borrowing the money, if they're borrowing the money and it's got some definite green environmental impact, it's probably a good thing. And so it's become a very big market. I don't know the numbers, but it's hundreds of billions of dollars are issued at the moment in green bonds globally. So what are some of the proceeds used for? Decarbonisation projects are pretty big. So some cities may be borrowing money to change their tram network from relying on fossil fuel power to being green.
Sure.
They might be putting in electric buses as opposed to carbon buses.
Sure.
Electrifying rail networks, that's a pretty big usage.
Sure.
Building buildings which are, meet high green standards is another reasonable usage.
And would you suggest that the demand is higher and the credit risks are potentially lower?
Well, the credit risk is probably the same.
Sure.
Because while the money is being used for a specific purpose, it's still the company borrowing the money.
Sure.
So if you've got a non-green bond issued by Infratel here and a green bond issued by Infratel here, this is used for anything that Infratel wants to do, and this one's used for a specific project.
Okay.
Right. But ultimately, it's the company is responsible for the overall risk.
Okay.
So the risk is probably about the same, but I think with the green bond, you get this extra measurable impact that you can say we're doing with our money as well.
Okay, that's cool.
Yeah.
Paul, we've covered a lot of stuff, tons of stuff. I've made a mess of my bit of paper that I've been making notes on. It's been really, really interesting. So if people want to find out more, obviously talk to your financial advisor. That would be my number one recommendation.
Yep.
And then visit, is it pathfinder.kiwi?
Pathfinder.kiwi is our website.
Okay, fantastic. We didn't really even talk about KiwiSaver, but there's a KiwiSaver offering there as well. But before we finish up, any parting words of wisdom that you want to leave our audience with?
No, look, I'd just say it's important to get advice for people, and don't be shy about seeking advice, irrespective of the amount of money that you're trying to invest. But ask questions of your providers as well. While a lot of providers aren't able to give advice, they can certainly give you a lot of information about what you're investing in, and I think it's pretty important to do that. The other, as I said, I'm full of anecdotes, but the other anecdote I like to use internally at Pathfinder, but also with other people, is if you can't explain it to your mother, you shouldn't be investing in it.
Right.
So don't just go with shiny baubles. Make sure you understand what you're investing in.
Yeah, good advice. Good advice. Awesome. All right. Well, thank you very much, Paul.
Excellent. I really enjoyed it. Thank you.
Cheers.